Welcome to the second ApexVol companion video. Today we're going to stray modestly from explaining site assets and navigation to explaining basic derivative structuring and the terminology involved. We will begin with the following: conversions, reverse conversions, cost to carry, synthetic calls and synthetic puts, and put-call parity. These are all intertwined, which will become more evident as we walk through the subject. This should assist the community in understanding some of the jargon and language and getting them comfortable with future tutorials. As previously mentioned, please don't be intimidated. This is achievable, and assisting subscribers into grasping the notion that a singular long-only exposure to capital commitment is not a mandate, and certainly not today with the market down 500 Dow points. First, we'll address the cost to carry calculation. The calculation is days to expiry divided by 360 days times the strike or the exercise price, same thing, times the broker loan rate, and we're going to use a broker loan rate of 5.5%. The first structure we're going to look at is the conversion, which can be referred to as a long or a forward conversion. Please note, this is a carry trade, not a volatility structure. It's necessary to get the community comfortable with it, which will become more apparent as we move forward. In front of you, you are seeing the ApexVol dashboard on the left, and you're seeing the screen for General Motors, GM. We had planned to use Apple as this is the ticker available to non-subscribers, but the dividend is next week, and that impacts the cost to carry, and we're endeavoring to keep this as simple as possible. On the right, you will see the calculation window. We are using a short duration term for the sake of example, so let's begin. The conversion structure involves buying the stock and hedging that long position by buying puts, entitling you to rid yourself of the long stock through exercising your long puts. This is done at a premium plus the carry, and we compensate for that outright by selling calls. So let's look at the legs. First, we're going to look at the calculation for the term that we're looking at, which is 22 days. So Ryan is highlighting the 22 days divided by 360 times the $68 exercise price times the 5.5%, and we get a long carry of 23 cents. And again, we're going to use a static rate of 23 cents long and short, and I'll get into that a tad later. So in the long conversion structure, as we look at the 68 strike, we are going to buy the stock at $68.55, and everything is relative to strike. So we are paying 55 cents over strike, and we have to accept that as a debit. And we are going to hedge our long stock by buying the 68 puts at $1.54. So we are paying $2.09 over plus the 23 cents in interest for a net debit of $2.32. And if we sell the calls at $2.42, which is where they're offered, we have a net credit of a dime. That is the forward conversion. We're now going to address the reverse conversion. Oh, I should mention, by being long the stock and long the puts, we are long the synthetic call. Until we sell the call, we are synthetically long it. So should we buy the stock and buy the puts and hold off on selling the calls, we are long the synthetic call because we have yet to sell it, and that is the synthetic aspect of the structure. Okay, we're going to move on to the reversal, and let's carry on. So as we address the reverse conversion or the reversal, in this structure, we are shorting the stock, so we are no longer paying carry, but we're creating cash that will receive interest in our account or short rebate. Two things to mention: we will be obligated to borrow the stock to deliver, and we are also exposed to early exercise, which I will expand on in the example. The structure involves shorting stock, and the obvious hedge will be to be long calls that through exercise will cover our short stock position, which of course is done again for a premium, and we compensate for that expenditure by selling puts. Those short puts expose us to being assigned and not being short the stock for the entire term. That's the early exercise component and impacts the rebate. The additional impact to the rebate is the cost of the borrow on the stock. Again, we're going to use a static rate for sake of example, but we need to mention those two considerations. And again, let's look at the legs. In this case, again, we're using 68.55 as the stock price, but this time we're selling the stock over strike and it's a credit, plus the 23 cents in short rebate. In order to cover the short stock, we're going to buy the calls at $2.30. We're buying them on the bid because we're that good. And that's $1.52 over. And that is the synthetic put. We have yet to sell the put, which we're about to, but until we do, we are long the synthetic put, again, getting you accustomed to the idea of synthetics. And then the third leg down, we sell the puts at $1.70, and we have a net credit of 18 cents. Those are the legs and so on. So in closing, let's mention this tutorial is to get you comfortable with structure. These aren't trades that you're going to do. These are institutional in nature, and there is something amongst equity derivative institutional desks where they refer to this market as the RevCon market, REV/CON, reversal conversion market, and they trade for pennies. But we're trying to get everybody acclimated to structuring, and that's why we went about it in this way. So, but comprehending, that calls can be puts and puts can be calls, and synthetic structuring cannot be underestimated. So again, the significance of comprehending the above will make it easier for you to going forward as we published our next video, where we will explain first-order Greeks and their impact on identifying advantageous pricing and how to monetize it effectively. And so again, I hope this video has proved to be of value, and we thank you for your time and attention. And if Ryan, if you have any commentary, now's your time.
I think for me, Larry, I think that's very good. For me, it seems complex from the outset, right? There's a lot of jargon and kind of wording to get your head around. But I think for myself, working with yourself for about 12 months or so, you become accustomed to it and it becomes second nature. And you almost kind of guess the numbers before having to do the calculations. So I think for anybody that's new listening, stick with it. And it will become second nature. It doesn't.
Yes, and if I might interject just an observation, again, Ryan does not have a background. He's not a Wall Street professional. Again, I have better than 4 decades of doing this, which I'm, somewhat uncomfortable sharing. But Ryan's been doing this for about a year, and he is now so comfortable with it that he has, designed this site, which I think is just awesome work. And aside from that, he is now, approaching me, and he finds things to do. And on rare exception, I don't have any difficulty with what he proposes. He sees the trades and he sees the value. So if, again, I don't want to, make this simpler than it should be, but it's achievable, with a little time, effort, and energy. Again, we thank you.